Hello, and welcome to the webinar, Revenue Recognition and Financial Reporting, CFO's Guide. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our discussion. First, we'd like to thank Oracle NetSuite for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Oracle NetSuite. We appreciate you joining us today. We welcome you to stay socially connected during today's event. For those of you who are on social media, you can follow us at Argyle Exec Forum and using the hashtag ArgyleDigital. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. Finally, and most importantly, please submit all your questions that come in during today's session into the chat section of the interface. Before we start, we'll have our speakers introduce themselves, and then we'll begin our discussion. Ida, can we start introductions with you, please?
Sure. My name is Ida Garay. I am Senior Finance Director for Acutech Inc. It's a pleasure to be here.
Welcome, Ida. Mario, can you introduce yourself, please?
Yes, I'm Mario Vasquez, Senior Director of Finance with the EW Scripts Company, also founder and CEO of Marvis Publishing.
Welcome, Mario. It's nice to have you here. So for our first question, why don't we start with some definitions? Can you both please briefly describe what you mean when you say revenue recognition? Mario, let's start with you, please.
All right, yeah, it's a process of formally recording and reporting income earned from the sale of goods or services. And it doesn't always necessarily occur whenever the sale happens or when the cash is received.
In your line of work, what do you mean when you say revenue recognition?
So we'll say, sorry.
Oh no, go ahead.
No, when we say revenue recognition, we're talking about an accounting principle that dictates when and how revenue is going to be recognized in the financial statements. And the underlying principle is that is when the services are rendered or performed or when the goods are delivered.
Great, thank you. So as long as we're kind of laying the foundation with definitions, Ida, can you please give us a brief description of ASC 606?
Sure. ASC 606 is an accounting standard that dictates how and when revenue recognition is in particular is going to be recognized. And the goal of that standard is to harmonize how revenue is recognized independently of where the industry is or even globally, because in the past it was more specific to industry. This standard introduces a 5-step model. That is how revenue is going to be recognized. So the first step is understanding the contract with the customer. And then within that contract, recognizing the performance obligations within the contract. Then third, recognizing the transaction price. Then after you have that price, you need to assign the price within each performance obligation in that contract. And finally, when you when you perform that obligation, that is the time when you need to recognize the review, the recognition of the revenue. Because in the past, there were so many other factors being considered, but now we have something that is applicable globally.
Great, thank you. Mario, how does ASC 606 implemented in the publishing industry, in your experience?
Well, it's typically whenever you actually, it's a lot of royalties in the publishing, right? So I do book publishing, so it's when the royalties happen, then that's when you're actually recognizing that whenever you earn the royalty. So it's one of the ones that actually goes with when the sale happens, and it's less about happening later. But in my regular day job, and so for the television, that's where EW Scripts comes in, then that's a lot of where this comes into play with the recognition happening outside of whenever the sale occurs. So, and I'll definitely give a lot of examples on that later on with other questions.
Yeah, well, we're definitely getting to that. So our next question is, what do we mean when we say something is a public business entity, and how can you tell if an institution is a public business entity? Mario, can you please take the first swing at that?
Sure. Yeah. So for me, I look at it as financial statements whenever they're making their financial statements publicly available, and they have to do it on a regular periodic basis, monthly, quarterly. It's typically quarterly, and the securities for them are not subject to any contractual restrictions or transfers. So that's my my definition.
Ida, what do you mean when we say something is a public business entity?
Yes, when a company is public, is that they issue securities to the public through an initial public offering, and their stocks are listed in the Security and Exchange Commission. And as Mario mentioned, they are subject to scrutiny. So they need to report to the SEC, to the Security and Exchange Commission. They need to make the financial statements public, not like private entities. We have our own financial statement. We don't need to publish that to anyone. Typically, you see that those companies in their website, they listed the investor relations. So the investors can go there and look for more information. And they are subject to many scrutiny because of the impact of the people. Anyone can invest in those companies. And therefore, that's why the financial statement needs to be public. And there is a lot of disclosures that need to happen. So every time that you go and see some financial statement from those companies, you see that the disclosures are many, many, many pages. And it is because it needs to be, there has to be transparency in their financial reporting to the public.
Great, thank you. So how can you ensure, this is kind of a different topic, how can you ensure that every stream of revenue is recognized when you earn it for every transaction? Ida, can we start with you, please?
Sure. First of all, it's understanding the revenue recognition principle. Again, it's not when you are paid for the services, it's when you earn the services. Second is following the 5-step model. That is critical because that is a requirement. Then, in addition to that, you need to have good internal controls. Internal controls that require going over the contract, understanding the performance obligations within that contract, and also setting the price, because we're going to talk later about something more about pricing, but setting the price, if you have good internal controls over that, that's going to be beneficial and ensuring that you're in compliance. Also training. Our financial staff need to be trained. Some people, and you see that when you go to a company and you ask the person, what are you doing? How are you treating this? And they tell you what they're doing. And it's something that they have been doing for 20 years. And you can tell that they don't have any understanding of any changes in the financial area. So they are doing things like they did like 20 years ago. And also work with your auditors. I always say, anytime that you're going to do something, just consult with your external auditors because they're going to be reviewing your financials and issuing an opinion on it. So I involve them all the time and make sure, am I doing things correctly? Is this in fully compliance? And I do that ahead of time. I don't wait until the end of the year. I do that throughout the year. And also being very thorough in the disclosures in your financial statement in terms of saying, this is the revenue recognition policy that we're following. These are the judgments that we're doing, the major ones within our financial statements. So everything is transparent when in your reporting.
Mm-hmm. Thank you. Mario, what do you think? How do you ensure that every stream of revenue is recognized when you earn it?
Yeah. So I've worked for really small companies of only a few people, all the way up to 6,000 plus employee, multi-billion-dollar a year companies, and doesn't matter on the size of the company. It comes down to having like a formal process. Everyone in the company understands when they make a sale, sign a contract, whatever it is, who they need to send that to, what the actual process is. It comes down to that good communication. You need to have the checks and balances within that process. Like I just said, you have that 5-step model now to make sure that you're going through that. And, we have audit coming in and making sure that everyone understands what the actual processes are for lots of different things, with this being one of them. And, someone new comes in, you need to make sure that right away you're letting them know what all of our processes are, and what they need to do whenever they come across a contract. It could be, someone's in the sales team, right? What do you do when you sign the contract? They need to understand what they do, having a generic process that works, that's not necessarily tied to people, but tied to roles, or to a team email that everyone can see. Like we have a contracts email that goes to the entire contracts team. We have something like that for procurement, that it goes to the whole procurement team. Order to cash, on all of our different areas of the company, we have that set up. So it comes down to just making sure that everyone understands what to do when they receive a contract or make a sale, to make sure that everything then does get recognized. And that's it.
I wanted to follow up on something you said earlier. So when you're working with someone who's been doing their revenue recognition tests the same way for 20 years, and they're out of compliance, or they're not doing it correctly, can you go into a little more detail about what you do in that situation?
Yes, most of the time we need to meet with management and go over the new procurement, because this revenue recognition, we keep calling it new, but it started in 2017 and 18. But we need to ensure that management is aware of the responsibility. That's the first step. And second, I'm surprised because typically the external auditors are the ones telling you, you need to be in compliance. But if in some small companies, sometimes they don't audit, they don't have an audit every single year, and that's when in the cases that I have found that they are not following that. But within the team, I remember discussions when the revenue recognition was not yet in place. We knew about it, but was not effective yet. And people had many questions. They didn't even know what that means and what was the difference between the old rule and the new rule. For instance, one example that I can give you is that the calculation of the reserves for allowances. That is one that in the past many companies, they estimated using their best judgment, and they just say a number. Oh, I'm gonna reserve 5%. I'm gonna reserve 1% of it. But now they are required to do something more consistent, more methodological, in the sense that they need to calculate it using historical data and do a calculation. But in the past, it was like whatever this number, if the number was good for the person and management was good with that, that was all. Today it's different. But again, training is something that I find that it's lacking in many companies. Or one person has the knowledge, but everybody else, they don't have an idea, and they are the ones making decisions every day about some revenue recognition aspects.
Great, thank you. Mario, what do you think? How has this come up in your career?
Well, we're making sure that, like I said, everyone's aware, especially when there's a change. There's going to be a rollout communication that explains what the change is, why it happened, how it impacts us, and if it needs to change our processes, making sure that we're meeting with the right stakeholders to come up with that new process before we go ahead and roll it out. But that's, making sure that the accounting team is staying up to date on whenever there's changes, and then meeting internally and rolling out those changes, and making sure, like I said, good communication and the formal processes of checks and balances and stuff are all in place, including when there's changes. So
yeah, don't let it can't be a surprise or a secret from anyone. So Mario, let's have you lead off with this question. Are there situations where revenue is recognized after the time of sale, and how do those cases need to be handled?
yeah, absolutely. There's a lot of times when this happens. So I'll give some examples on when this is the case. So in each scenario, the revenue recognition is deferred. past the point of sale, it needs to align with the transfer of control of the goods and services to the customer. So first example here will be, the customer acceptance provision. So there's lots of times in the contract that, you don't actually get to recognize it until the customer accepts it. And it will specifically say that they have to accept it. They have the right to reject it, whether it's a good or service. So you can't recognize it until you receive that acceptance. It could be verbal, it could be written. Usually, if it's written into the contract, it will be a written acceptance of the good or service. So that's definitely one where you can't recognize it, and it'll be delayed. Another example be extended warranties or maintenance contracts. These are typically recognized over the life of the contract. Instead of at the time of sale. And that's the reason for it. It's meant to align with the seller's obligation to provide the services or cover the warranty claims throughout that contract period. Some examples more in line with the television world that I work in every day. Most of our revenue comes from commercials. So if you're watching on cable or over the air, you're going to be seeing our commercials. And we sign contracts with the agencies for the advertisers, and that'll be done. It could be done the day before, could be done a week before. It's typically, anywhere from a week to even like a year ahead of time. We go through something that's called the upfront. We sign lots of contracts that will be for anywhere from 3 months to a year and 3 months after signing those contracts. So that will be a very long delay there, because we don't actually get to recognize it until that commercial airs. So it'll be the day that it actually airs, we get to recognize it, because then we've met our obligation. Another way in our television industry is, without the commercials. So Netflix, right? You're not going to have your commercials on Netflix. We do produce original series as well, and you can find some of our stuff on Netflix. And so when we sign a deal with Netflix, there's others as well out there that provide similar services that we've done deals with. But in this case, it's season by season for whatever series we're signing a contract with them on. As soon as we deliver those the episodes to them, and we've completed transfer over to them of every single episode of a season, we've now earned that revenue. And a good example with this, we just recently had this one where it was 5 seasons that they signed on for. 3 of them are completed and ready to go. So as soon as we send those over, which could happen the next day, usually it might be like a few weeks or the next month, well, then we get to recognize those 3 seasons because we've met our obligations. But then season 4 is currently being shot. It won't be ready for like 6 more months. Once that's done, then we get to recognize that revenue. And then the next season, it's not even being filmed yet. It's not going to be until sometime next year. So once that is completely done, then we'll be able to recognize that season's respective revenue. So it does go typically in these cases, it's the revenue is broken down on a per episode. And so each season isn't always necessarily the same number of episodes. So you could have a different amount of revenue that you recognize for each respective season. Yeah.
Great, thank you. Ida, how does this come up in manufacturing? Or what situations are there where revenue is recognized after the time of sale?
Yes. One common thing in manufacturing is that we typically, in our ERPs, we have said that once we ship the goods, we recognize the sale. However, even when that is most of the time recognizable, it depends on the Incoterms. It depends on the freight agreement with those customers. Because, for instance, for a customer that the goods need to be received by them before they can be let me explain this. We have a variety of customers here, right? And for some of them, the shipping point, this takes, okay, this is, I earned that sale. at the point of that I ship them. But there are some others that is not until they receive it that I can count that as a revenue. And that is not simple. If you have a good system where you can accommodate those different situations, you can do it systematically. However, many of us need to do something manually. That is, take the group of customers and decide, okay, this group, I can recognize 100% of the sale at the end of the period. But for this, I need to estimate the transportation time, that depending if it's domestic or international, are for 2 to 3 days, or can be maybe 7, 10, or even 20 days. So it is complex, but it's depend on the contract with those customers. Another example that I can think about is consignment sales. In consignment sales, you ship the goods, but you don't consider that a sale until one of two things happen. Either the customer uses that consignment inventory, or there is a certain period of time, 3 months, 90 days, depending on the days that you have contractually, until that expired or the customer uses the goods. That is the point when you can recognize the revenue. Bill and holds. Bill and holds is when you ship the goods. Oh no, you're paid for the goods, but you don't ship that until later, when the customer said, "Oh, okay, you can ship that now. I need it now." Even when you receive the money, you cannot recognize a revenue, but you have is a liability at that point. And then when the time comes that you need to deliver the goods and the customer is in control of the goods, that is the time that you recognize the revenue.
Let's move on. The next question is, what are some things that people need to keep in mind as they identify performance obligations in a contract, as you're composing those performance obligations? What are some rules you need to follow? Ida, can we start with you on that one, please?
Sure. The rules that you need to follow is to determine if the good or service is a distinct good or service that the customer can have the benefit of. And because for each distinct good or service, you need to recognize that as a performance obligation, right? And it needs to be separately identifiable by that. Let me give an example. Within one contract, you can have many goods or services, but if each of them can be separate and the price is, you can identify the standalone price for that service, it is a different performance obligation within that contract. I have seen that the most difficult thing is to really go over everything that is within a contract and doing the determination of what can constitute a distinct good or service. For some, when you're talking about goods, it's very easy. The good itself, once it's delivered, you did, perform that obligation. But when you have different services within one contract, you need to identify the specific distinct goods or services within that contract in order to recognize the revenue for it.
Mm-hmm. Mario, what do you think? What do you keep in mind as you're identifying performance obligations in a contract?
Yeah, so similar to what Ada said, it's the distinct good or service, and so it's it's considered distinct if the customer can benefit from it, and so when you're going through the contract, that's what you're looking for. And then think of that last example that I gave on delivering the seasons to Netflix, right? For the respective episodes. That's we're looking for that distinct benefit that they can now air those on on their platform, because now we've delivered them to them. So that's when we can do that. And it's defined in the contract. It's specifically spelled out, makes it nice and easy. There's no guesswork there. And so another thing here is you have to, employees that are reading through this need to keep in mind the variables that can be in there, such as like bonuses, discounts, penalties, whatever it's called out. And then you have to assess whether that relates to a separate performance obligation, or it should be allocated across all of the obligations that were identified in the contract. And so there's a there could be a lot of different steps in there. It's not always the same. It's not always as straightforward. Sometimes there's estimates or not clearly defined things for you to follow. So a lot to keep in mind there.
Okay, thank you. Before we move on to the next question, I wanted to call everyone's attention to the poll, which you can get to on the right-hand side of the screen where it says polls. It's not too late to provide an answer to the poll question. The question is, how automated is your revenue recognition function? And the majority of respondents said the options are highly automated, some tasks are automated, little or no automation, or don't know. And the answer that got the most responses was some tasks are automated, followed by little to no automation, followed very closely by highly automated. So let's move on to the next question. Mario, can you please take the lead on this one? What general principles should people keep in mind when they're allocating prices to performance obligations in a contract? This is similar to the previous one.
Yep. Yeah. So there's a number of them there. So there's the standalone selling price. So you can allocate the transaction price to each performance obligation based on that standalone pricing.
Mhm.
If that's available in the contract, that's much more straightforward. Then, like I said, it's not always clear. So sometimes you have to use the estimation methods, and you'll use appropriate estimations to determine a standalone price for every individual product or obligation that's met in there. There's variable consideration, so you can allocate proportionately based on specific variables. So there could be a number of different things that could be a variable called out that could make things fluctuate up or down, and you'll have to use that and take that into consideration when you're applying that. And then I'd mentioned like discounts and stuff, so you have the adjustments for discounts or concessions, so you have to make sure that you're allocating any adjustments to each performance obligation. So an example that I like for this that uses multiple different principles all in the same scenario, I was thinking of a software company, and you have multiple products that you're selling all in one contract. There's a software that has a one-time fee, and say it comes with a 3-year software maintenance package as well. So you're paying one fee for the license, and then another fee for 3 years of software maintenance. And you're buying another product that has a monthly subscription, and maybe you're agreeing to 1 year or 2 years, whatever the time period is for that monthly subscription. And then say there's also the discount. And the discount is just a lump sum discount for the total overall package. So one of the first things you have to do here is actually look at that discount. How are you going to apply it across all of it? If it's just a lump sum for all of it, it should just go proportionately based on the dollar amounts to each of the different products in there. And then you have to look at when do you actually earn each of those respective revenue streams, right? So your one-time fee for your software, you probably earn it as soon as you actually give them the software. So pretty much probably whenever you actually sign the contract, you're probably pretty quickly giving them that product, or they download it right away, or whatever it might be, and then that's earned. But then the software maintenance is something that you usually will spread over the life of that agreement. So in this case, 3-year software agreement, you will spread that over 3 years. And then your monthly subscription for the other software would also be typically, right, spread over the same commitment term. There could be, say, maybe outs in the contract to where you're maybe putting something in reserve, or you're only you only recognize part of it, and then you want to hold that back to see if they're going to cancel it. There could be different things in that scenario. So that was an example. I like to be able to see multiple different methods that you might have to do all at the same time.
What do you think? What principles are you keeping in mind when you're allocating prices to performance obligations?
The main principle, as Mario said, is the standalone pricing. For instance, a telecommunication company can offer a smartphone at a very reduced price, but that's contingent basically of buying a 2-year service contract. In that case, you can see that the standalone price of that smartphone can be 10 times what they are charging. That's why they can combine and consider those two as one performance obligations. But something for me that is important, that sometimes company, for convenience, they bundle services or products. But even when they bundle it for convenience, it doesn't mean that it's all of them are one performance obligations, because if each of them, the standalone price, that's why we keep saying that the standalone price is the critical factor. The standalone price for each of them tells you right there that it's the same price as if they were selling separately to another customer, then each of them becomes a separate obligation within that contract, even when they bundle it. So some companies think that just because they bundle it, it means that it is one performance obligation, and that's not the case.
Great, thank you. I wanted to call everyone's attention to the second poll, which is on the polls tab on the right-hand side of your screen. And that poll question is, do you ever have trouble assessing if a contract with a customer exists? Majority answer is no. The answer options are yes, often, yes, occasionally, no, and don't know. And the majority of respondents said no, followed by yes, occasionally. Let's move on to our next question here. So when should a contract modification be accounted for as a separate contract? Ida, can you get us started on that one, please?
Yes. We kind of touched a little bit of this before, but it's when the standalone price of that additional aspect that you introduce to the contract is the same price that you will charge another customer for the same service. You need to recognize that as, that is the trigger to know when you need to recognize as a separate contract. It's not that we are going to actually write a separate contract, but it is we're going to treat it like a separate contract. So basically are two things. If they are distinct good, so you have already several services or products within the contract, what you're adding, the standalone price is comparable to the market, to what you will charge to another customer. And secondly, that it represents a distinct good or service. If those two are met, then you need to treat it as a separate contract.
Thank you. Mario, what do you think? When should a contract mod be accounted for as a separate contract?
Yeah. So there's like 3 things that for it to meet. It has to be a distinct good or service. It called out in that modification. There's an increase in the overall price of that you're getting for revenue, as well as an adjustment to the scope. So if all 3 of those are met, then we're handling it as a separate recognition. If not, then we just treat it as part of the existing contract and make the necessary adjustments to that and recognize the revenue as needed.
Uh-huh. So moving on, how do you properly account for onerous or loss contract with customers? Mario, let's start with you because you had a good answer to this yesterday.
Typically for us in television, it's covered for us in our bad debt reserve. We don't have a lot of backing out. We're not able to collect or have a bad contract in there. It's usually just when we have contracts that aren't being followed through, it's because they actually had an out, which is another one of those reasons why you wait to recognize. It's not at the time of the sale. You have to wait until we actually have the commercial go to air, but it's usually because they actually do have an out in that contract. So, for us though, it is just typically in the bad debt reserve. And it's if it's material, then you have to look at it definitely separate as a one-off and just assess what you need to do with that. And typically you'll want to write that off as soon as you know that it's a onerous contract. Then you want to make sure that you're accounting for that immediately and not waiting.
Thank you. Ida, what do you think? How does your company properly account for onerous or loss contracts with customers?
We don't typically have much of that, but in general, we call an onerous contract when the cost to fulfill the obligations is higher than the benefits that we're expecting for that contract. And when that happens, we are required to book an impairment loss. I was thinking about an example for this, and let's say that we have a lease agreement for 5 years, and then on year 2, you determine that you have no longer use for that space, that office space. But contractually, you're obligated for 3 more years, right? And then you determine, okay, I can sublease. If the contract allows for that, you can sublease that for, I don't know, as a portion of the space for, let's say, $30,000. Then for the upcoming 3 years, you have $300,000 of commitment that you can offset 90,000 of it. So you basically have a $210,000 there, a possible impairment. But the ruling here is for the impairment is that you need to measure it and record it at the present value. So you need to calculate the present value for each year individually and sum it up. And let's say that you use 5% discount rate, will be like 190 or 197,000 that you need to book in your, right now. You book it at the time that you become aware of the impairment. So not necessarily, you don't need to wait until that happens. You need to book it when you discover it. And that's why it is important to keep reviewing our contracts. And if some of this happen, in our case, it doesn't happen with contracts, it happens more with equipment. For instance, the manufacturing equipment that we are not using, we are required to, if there is no future use for it, you need to record an impairment. And that's what we see a lot in manufacturing, more related to equipment than with contracts with customer. But it can happen. It's uncommon.
Thank you. So let's change the channel a little bit and answer some questions that are coming in from the audience. Remember, audience members, it's not too late to submit questions using the chat feature. So why don't we jump right on in and address some of these? The first of which is, what's the best way to stay up to date with changes? You don't know what you don't know. Heidi, can you please take the lead on that one?
Yes, the best way is through continuous education, participating in training like this one, keep you updated, because like the person said, you don't know what you don't know. But I think that for us, for CPAs, we have to continuously keep educating ourselves. But if you're not a CPA and you don't have that requirement, you can either go to the resources, check on any FASB's procurements and anything new in the field. But for me, I will say the easiest way is to keep in contact with your auditors, with your external auditors. They are always up to date in every single change. And optimally ask them not only what change they see right now, but the changes that are expected for the upcoming years. Because sometimes like this ASC 606, since 2014, we knew about it, but it wasn't affected until 2017 and 18. So that is for me the easiest way of keep current. Keep asking, keep meeting with your auditors. They need to necessarily keep updated so they can help you to become more knowledgeable of the changes.
Great, thank you. Mario, what do you think? How do you stay up to speed with changes?
I was gonna say, you just covered pretty much everything I was gonna say, Ida. But yeah, it's the same kind of thing. It's continuing education. So types of courses like this. Being members of organizations to where you talk about this on a regular basis. Your external auditors was the very first thing that I had thought of as well, because they're the ones usually coming to you right away to say, hey, are you aware that this is coming? And what's nice is that it is always in advance, so you have time to prepare. I remember something with the lease changes, and we had like 3 years notice on that, and had to figure out what to do with that. And there's different publications that come out. You can be on email distribution lists. You can just have peers at other companies that you regularly just network with that can keep you up to date. All of that type of stuff.
Great. Are there any specific resources that either of you can recommend?
My main thing is the external external auditors, and then I do network a lot, and so it's staying in contact with lots of people that I've met in person, worked with before, or just even met on LinkedIn, and staying up to date in different groups on LinkedIn.
Sure. Ida, how about you?
Yes, that's for me. That's the main one, because the rest is just checking FASB pronouncements, and the ASC. You Google nowadays. You Google for that using ChatGPT. It's a new tool that it can tell you what is new and what is out there. But for me, using your external auditors, it's more beneficial, because let's be honest, sometimes we read that and it is in a language that we cannot understand. It is too technical.
Mhm.
So you read over it and you end up like you studied. So you don't understand anything. It happens to many of us. It's like we need to read it many times. When you consult with your auditors, they can tell you black and white what it means. In particular, what it means for you in your particular industry, in your particular case. So you're going to get more reliable information than just reading, some procurement that is new, and you just sometimes don't understand, because it requires, even for our auditors, it's required them to read that many times, to discuss between themselves, to see how they can implement things, and they do that job for you. It is, for me, it's a lot easier and more effective.
Sure. So moving on to the next question from the audience, is it possible for you to provide the 5-step model? Mario, do you want to take a swing at that one?
Sure. Yeah. So you could do a quick Google or anything like that. You'll find lots of different sources out there that you can go to get it. But it's the 5 steps are: first one is identify the contract with the customer.
Mm-hmm.
Number 2 is identify the performance obligation in the contract. 3 is determine the transaction price. 4 is allocate the transaction price to the performance obligations. And 5 is recognize revenue when or as the performance obligations are satisfied.
Great, thank you. So the next question is, and this is kind of related, are there companies which track all of the changes by industry that companies can subscribe to? It's easy to say stay up to date, but are there mechanisms in place? If possible, please give an example.
Not that I'm aware of. I know that there's certain things in certain industries that you can get on industry-specific email lists, but to say that there's one place that tracks all of it for certain industries, not that I'm aware of.
It's difficult, but
Yeah,
something good about, for instance, what we are discussing today. More and more, we see things that are doing, like, this is intended to be global, for instance. So it's not industry specific. So in order for you, something that I recommend is sometimes you subscribe to big firms. I'm not going to say any names, but I don't know if I'm allowed. But some big firms, they keep sending, information about new procurements, new standards, and they can email that to you. So if you subscribe to them, they can email that to you, and you're always going to be up to date on things. Sometimes it's too much. For instance, I'm subscribed to some of them. Sometimes are too many emails to manage. That's why I keep saying that your auditors are the best resource that you have. But there are some that you can subscribe to. And again, I'm just going to say the big accounting firms. They have, all of them have those subscriptions that you can receive.
Mm-hmm. The next question is, we are really struggling to get our revenue recognition systems under control after several costly missteps. Do you have any advice for us? Ida, can you take the first crack at that?
So it depends on, so we don't have a lot of information there. So struggling, depending on what the struggle is. They mentioned something about it, if the system or how to be consistent.
That's assume it's a problem with a system that they're not. Something is going wrong.
Okay. Because there are a few things that can go wrong, but Sometimes there's the system. The systems sometimes are not robust enough to handle different scenarios. In the example that I did before for us shipping goods, sometimes the system is not good enough for you to put a rule or the setting by customer that dictate this and this customer, this is the rules that you're going to follow. This customers, you're going to follow different rules. In that case, there are some external softwares that can be acquired. I don't have a name right now in my head, but there are some external softwares that you can use to do some rulings between, that you can add to your system, because the alternative is to do it manually and it is too cumbersome. If the problem is by understanding what you need to do or not to do in terms of revenue recognition, for instance, at the end of the year, because my system is not that robust right now, I need to do a calculation. So I decided I'm not going to do it monthly because it's too much work, and I need to make sure that by the end of the year, I do that calculation that depending on where I'm sending my goods, I'm doing some analysis of, okay, this is type of customer, this is the arrangement, this is domestic or international. I'm gonna use my best judgment, just knowing how much time it takes for them to receive the goods, 2-3 days for domestic, again, 10 days for international, and discuss that with the auditors. And if that makes sense and it's reasonable, that's what I'm going to use, because I don't have the system to do it for me. So those are the things that I can think about. The rest will be meeting with your external auditors, because again, they are a resource. Sometimes we don't use it often. We think that they are there just to audit us at the end of the year, but they are a resource throughout the year for things like that. Sometimes they have great ideas for you to put together and meet the requirements.
You. Mario, what do you think? What advice would you have for someone whose revenue recognition system has gotten really out of control?
Yep. So I've led the implementation of 4 different software systems, and I can tell you that it comes down to your processes that you're putting into place, right? If you have a bad process and you put in a new software system and you just replicate that bad process in the new system's not going to help you at all. It will probably just make things worse. So it's about making sure that you have a good process in place and recognizing where the gaps are, where the holes are, where the issues are that you can fix. The newer software systems can help tremendously, but as long as you implement it correctly, so it's making sure you get the right expertise in-house, even if it's just for the implementation purposes, that have done it before, that can give good recommendations so you can get those processes in place. And if it's personnel instead of the actual software, then it's the same thing. It's finding what's the issue in the process, what's causing it, and then tackling how best to change it, and then documenting it, right? Because people change, right? There's turnover. So it's always trying to make sure that you have the overall process properly documented and have it not rely on a specific person, right? And it's just making sure that it's you're always looking at it as roles and their responsibilities for each step in the process, and where the systems come into play, and then making sure that it's all cohesive and implemented nicely there.
Yes, if I can add something that I have found out is that sometimes we think that the system is not capable of handling something, and it is the way that it was implemented. So sometimes what we do is hire some consultants that have expertise in that particular ERP, depending on the case, and they can check if the system is capable of doing it. Sometimes it's you need to tweak some of the settings, and you get exactly what you need. Sometimes it's not doable, but at least it's worth evaluating if that's the case, because again, doing things manually are going to be just too cumbersome.
So I wanted to point out the third and last poll before we go on to our next question. The poll question is: a performance obligation is the unit of account for revenue recognition. And most people got this right. The vast majority of people got this right with true. It's a true, false, don't know question. On to our next question here. The next question is, what's the biggest mistake you've seen companies make in trying to automate some of their revenue recognition, and how did they get past it? Mario, can you please start us with that one?
Good question. Trying to think of me seeing an example of where it hasn't worked. I can't think of an example that I've seen where it didn't. Right. This is where it comes down to your personal experiences, right? So I've seen other aspects of accounting be implemented poorly to where you wish that you did it differently. But as far as revenue recognition, I can't think of that example right now.
What do you think? Has this come up for you?
That hasn't, but thinking about it, I'm thinking that a very big mistake will be not understanding the contract correctly. And then if you put in place, for instance, if you try to do something systematically to automate it based on, I don't know, being customer specific, but it is not just customer specific. You can have two customers that are identical in most of the aspects, but there are performance obligations within their individual contracts that are unique. And you cannot treat the two as one. That happens a lot when we're trying to, okay, let's divide in 4 and do 4 big areas. But because it is performance obligations driven, it is not easy. You need really a very flexible system to accommodate all the different aspects within your ERP. Because again, it can be a disaster. It happens. In our case, it didn't happen with this in particular, but it has happened sometimes when we're trying to put up some rules for sales that we think are in a certain way. And when we look at the contract, we didn't have all the information. So again, and it is very difficult and time consuming to go over each contract and understanding the performance obligations. It is something that it's done hopefully once and you get it right and then you work on that. But that needs to happen first before you try your system to do it for you.
Mm-hmm. Great, thank you. The next question is, do you anticipate any changes to ASC 606 or the way it's implemented over the next couple of years? Ida, can we start with you, please?
Yes, I don't anticipate any changes. That is fairly new. It is global, and it is done to be more comparable between industries and even globally. I don't foresee changes, at least for the coming years.
Thank you. Mario, what do you think?
Yeah, I agree. It's probably too soon to see changes that quickly. It's if there's lots of I don't know the right word, outrage, or people complaining about it, saying you shouldn't have done that. This is the reasons why, and there's valid reasons. We probably would have heard that already by now. So it probably would have already changed. So I don't see a reason why it would change anytime soon.
This question is, we are under a lot of pressure from leadership to make our financials seem more positive than they actually are. What should we do? Mario, can you take the first crack at this one, please?
It's all about your ethics and doing stuff that's correct and proper. And I've heard so many times where people are like, well, what if I can go collect the revenue now and get people to prepay? Will we be able to recognize the revenue? I'm like, no, that doesn't change accounting. There's rules for a reason. We have to follow the rules. So just, make sure that you're strong to be able to push back, because I've had very strong leadership that tried to get stuff to be changed. And I said, I'm not going to put my ethics on the line to make the company look better. Luckily, that was not with this company that I'm with now, but no longer have to work for that person. But I stuck to my ethics. You just have to be strong to stand up to them. And then, if there's ways that you can make it look better and you're within the rules, I guess that's fine, but then also you have to make sure you're consistent, right? That's now our policy going forward. You can't flip flop to make it look better every year by changing to the way you recognize revenue.
Thank you. Ida, what do you think?
Yeah, so I have been there, unfortunately, many, many years ago. But some small companies where the owner is not even aware of what is a requirement. And I remember going to a place where the owner was fighting with the external auditor because she doesn't know what she's doing and she was doing everything right. And what I did in that case, for me, I think that it's my responsibility to educate them. It doesn't matter if it's the president. It doesn't matter if it's a strong personality, which it was. Ethics for me are non-negotiable ever. So I'm going to make sure to explain to them what is the requirement. For instance, let me give you one example. Some people that they don't know the rules, the finance rules, they think that because you receive the money, it is a revenue. And it's not like that. And I said, no, I need to explain. No, you receive the money. What have you done to earn it? Nothing. So I need to speak to them in very basic terms. Did you do something to earn it? No, to them, instead of a revenue, it's a liability. Conceptually, they don't understand. How can money in my pocket be a liability? And it is because you owe the service. But again, explain to them, my advice is explain to them why things are required. It's not that you're making that up, it's a requirement. If something doesn't qualify for revenue, you cannot recognize it. And if they insist that you do things wrong, knowing that is wrong, my advice is don't keep working with that company. Because sometimes you need to make strong decisions. You need to do it for yourself. It's going to pay off in the future. So you don't compromise your integrity ever.
Good, great. So the next question is, how can you tell if you have a contract with a customer under ASC 606? Ida, can we start with you on that one?
If you have a contract, well, if mostly the contracts are written, but sometimes are oral. So if you need to perform a service or you need to deliver a good, you have a contract with that customer. That's will be like the basic terms to define that you have a contract. And I say that because sometimes you don't find any contract, but if you have been performing an obligation, again, products or service, you have a contract with them, even if you don't have anything in writing. I always recommend having everything in writing. If you don't have it, having the conversation with the customer to see, can we formalize this to have it in a document that better tells me what we have. Because sometimes you do something because the previous company, or if you acquire a company, they have been providing those services, but you don't have any documentation about it. But again, if you have been providing service or delivering products, you have a contract with them, even if it's not written.
Mm-hmm. Mario, what do you think?
Yeah, and I mean, pretty much everything's going to fall under it. Almost everything's going to fall under it, right? As Ida said, it's like if you're selling goods or services, you're probably going to have all of your contracts or sales fall under this, because like Ida said, it's not necessarily everything is a contract. It could be verbal, but it's best practice to have the actual contract. And I can't think of anything in our business that doesn't fall under it. So, not knowing your specific industry or, what it is how you guys earn revenue, it'd be hard to say if it's not. So it probably is. So, yeah. Would be my guess.
Great, thank you. Unfortunately, that's all the time we have for today. Thank you both, Ida and Mario, for this amazing discussion. And this concludes today's webinar, and I want to thank everyone in the audience for joining us for this excellent virtual event. And thank you again to our partner, Oracle NetSuite, and enjoy the rest of your day.